It's great to be with all of you here this morning. I have been asked to speak about the general insurance market worldwide. I will touch on that. I'll also talk about the different economies and where opportunities are. But a major part of what I'm going to talk about is the way we have to talk to people, and specifically with the crisis that we've just gone through. And I'm going to put a major emphasis on that. And at the very end, what I'm going to discuss is, I think, the difference of our business, how our business is different, and the huge impact that we can have on other people. So that's what I'm going to be here to talk to you about. Anyway, if you take a look at this map, you'll see where a lot of the opportunities are relative to the idea of insurance penetration and also GDP growth. And I'm also going to give you a perspective of what we view, because we're a very big U.S. company, but we're expanding out to get into the to also get into the international markets. And if you also take a look at over here is the fact that the international markets are growing a lot faster than the United States. So a major portion and a major push from our company, for example, is to go international. And I'm being sponsored here today by $1 Million Roundtable. And I'm going to be one of the speakers at their $1 Million Roundtable experience in Korea. And I know that they'll be looking to do a $1 Million Roundtable in 2011 here in Europe. So $1 Million Roundtable, which was primarily a U.S. concern, got very international, is going to be extending itself out because we think there's a great deal of opportunity here. But if you take a look at the opportunities that you have here, given the fact that you have this poor pension system, you have an aging population, which many of us have, and you have low life insurance penetration, one of the things that's important is the fact that you have a great deal of opportunity, and I think all of you should take solace in that. But let's take a look at the economies. And this is something from a group called ISI, and they talk about a diffusion index. What they do is they monitor 300 proprietary sources of information. And what they do then is say, as a result of this information, is it positive or is it negative? So this isn't too deep, because if it's down, it's bad. If it's up, it's good. And this is the United States, and you'll notice, for those in the back who probably can't see this, this is not the stock market. This is what the sentiment was built around. And bear in mind, a lot of things are driven by sentiment in economic terms. This was 2005, 2006, and you notice this is the U.S., that it was beginning to come down, and then when we had the drop, you see what we had was this double dip. And the double dip here is in March, and it goes all the way down here towards March and then goes back up. That's the United States. When you take a look at Western Europe, it's very similar. They had a double dip, and that worked, and that was there. But one of the things that's really interesting is when you take a look at the emerging markets, and you'll notice that just before the crash, unlike the U.S. and Western Europe, it was a lot healthier. It went down further, but then came right back up. And one of their observations in terms of looking at it is the fact that there's now a synchronized global recovery led by emerging markets. So there's a tremendous opportunity out there, I think, for the emerging markets and your businesses. Now, having said that, one of the things that we have to deal with is the crisis that we had just gone through. And I remember back in March, this was the Wall Street Journal March of this year, where it came out when we had that double dip, stocks hit 1997 levels, signaling a long slump. And everybody was very depressed. But one of the things I did when I was out talking to everybody, what I said when I gave a lot of my speeches was the idea of, don't waste this crisis. Don't waste it. Because probably in your lifetime, you won't meet more people with so much money, so annoyed at their current investment advisor, and anything that you recommend would probably rebound. So I didn't see this as something that was bad. I saw it as an opportunity, and specifically for the insurance business. And a lot of people thought I was nuts. Well, guess what? The third quarter of this past year was the biggest quarter in the U.S. since 1939. And so a lot of times when the market goes down, that's the part that really shows opportunity. So, having said that, let's do some comparisons. A lot of people came back and said, you know, this recession is worse than the Great Depression. I'm showing you now, this is US data. In the Great Depression, 9,000 banks failed. In the United States, it's now up to 100 banks failing. You see the unemployment rates. You see the dramatic differences. This recession that we went through is nowhere near as dramatic as the decline that we had back in the Great Depression. The other thing that's important to note is we go through these things now and then. I started in the life insurance business in 1974. One of the worst periods anybody would want to choose to get into the life insurance business. That was when the oil prices started to go up. And then from 1978 to 1981, we had record high interest rates, record high inflation, and low productivity, and an economist would tell you that that was virtually impossible to happen, and yet it happened. That was the environment we were in. And take a look at this. This is Business Week magazine, a very prestigious U.S. magazine. And what it talked about on the headline was the death of equities, that the equity market was dead. The S&P 500 closed at 109 when that magazine was done, and just this last month, the S&P closed at 1,000, more than 10 times greater, and outstripped inflation. And in fact, as of yesterday, it's up to 1,100. So we've been here before. Take a look at what happened in 1987 when we had that big crash, the single biggest percentage drop that we experienced in one day. And you know what happened is the S&P 500 closed at 255, and again you see that it closes at about 1,100. But let's deal with something that I think is very important, and that is attitude. Faith in the future, from an investor's point of view, is the only worldview that squares with the historical facts. That's something important to bring into play. And let's take a look at some more facts. What you're looking at here are the 13 bear markets that we experienced since World War II. We've had 13 of them. So everyone is upset about this current crisis. Look, since World War II, we've averaged a bear market every 5 years. That's a decline of at least 20%. The average decline is about a third, 33%. The average duration is about 15 months. By the way, this chart doesn't show dividends, and if dividends were in here, it would be more muted. But take a look at this. The trough in 1949, the S&P 500 was 13.6. When you take a look at the trough that we just experienced in March, it was 676. The point is that this trough here that we experienced just this past year is 50 times greater than the trough that was experienced back in 1949. But these are the facts. And you know what? One of the problems with our industry is we always deal with the facts. But we deal with people. And you have to be able to communicate this to people. Because everybody knows we run into bear markets. But the problem is how do they react when they actually happen? In fact, we have to prepare people for this stuff. Why do you think when a cruise ship leaves, they do the lifeboat drill in the harbor? They do it in the harbor because they don't want to do it out in the middle of the Atlantic. And one of the most important things that we have to deal with as people is their perceptions and their emotions that might get in the way. Because here's the point. No bear market feels average, even normal, while you're going through it. It just feels like it's the end of the world. So, having said that, when we're talking to people, you have to understand that people have two sides of the brain. This is the left side of the brain, the analytical side, the one that looks at the charts and the graphs and the facts. And this is the emotional side of the brain. And I would say that our industry has spent a lot of time creating left brain analytical tools to solve right brain emotional issues. And that's where some of the fundamental disconnect happens to come about. So how did this happen? Well, it's part of a broader picture. It's not just us. You see, because we have to address not only the facts, we also have to address the emotional side of the equation. Because it's the way people react emotionally that sometimes can get them to react poorly and to their own disadvantage. So, having said that, there has been an explosion of books on this topic about the left brain, right brain. It's not just the financial services business. It's all professions. In fact, the worst is the medical profession. They're trying to teach them how to talk to people, because they usually come in and give the facts. You got cancer, you'll be dead in a month, have a nice day. Walk out the door. It's terrible. But one of the correlations they found was the instance of malpractice suits. They found that there's a direct correlation to malpractice suits predicated on the length of time the doctor spends with the patient. And the break point is 16 minutes. Anything below 16 minutes, there's a high likelihood of a malpractice suit, even if something bad didn't happen. And anything above 16 minutes, there's less likelihood of it. See, here's the point. People will sue for lack of relationship, and they're not even cognizant of it. And so that's why we have to be aware of the fact of also the right side of the brain and how we go through this. You see, it's part of a bigger paradigm. We have evolved from the industrial age, or rather the agricultural age, to the industrial age, and now we're in and exiting something called the information age. And the information age puts a premium on a train of thought that's narrowly reductive and highly analytical. And while those skills are still important, they're no longer sufficient. And here's one of the legacies of the information age for our business. It's something called selection and timing. This is how it goes. Do business with me because I'll select the right stuff and I'll time you out of it at the right time. If you say that to people to differentiate yourself or intimate it, you will build a referral-free practice. Because guess what? Nobody can do it. Nobody can do it. It is virtually impossible. There is no statistical evidence for the persistence of performance. And we have been feeding people in the financial services business that line, come to me, we'll do better, and it's virtually impossible to do. So ultimately, when somebody outperforms, or a neighbor outperforms one of your clients, what they do is they go on the gerbil wheel to nowhere to find someone to do the impossible, and your agents are back rebuilding their book. The only possible thing that we have a sense of managing is clients' behavior. And that is the whole idea about an economic behavioralism. See, here's the deal. Performance is not a goal. It's not a goal. Saving for retirement is a goal. Protecting your family in the event that you're gone is a goal. And all unsuccessful investing, all successful investing is goal-oriented and is planning-driven. All unsuccessful investing is performance-driven. So you have to always have a goal that gets attached to it. And the important part is the idea in terms of when you talk to someone, you're talking about the fact that our relationship will be one where I'm going to be dealing a lot with your emotions to make certain that they don't get carried away. So, having said that, there's a fellow by the name of Nick Murray. I don't know if you know him. I will give you his website here. It's www.nickmurray.com. Some of you might want to write that down and order this book. It's Nick Murray, Behavioral Investment Counseling. How do we put this into practice? There are 3 principles that he talks about, 3 behaviors. And the first principle is the idea of faith in the future. Faith in the future. And why wouldn't you have faith in the future? Look, in my lifetime, my mother was born in 1911. Her life expectancy was in the 50s. When my sister Peggy was born in January of 1943. By the way, she's ecstatic I'm telling the planet how old she is, all right? But anyway, when she was born in January of 1943, her life expectancy was in the 60s. And when my daughter, Sarah, was born in 1983, her life expectancy is in the 80s. So we've had this explosion of longevity. Normally, I have a stopwatch, but I don't have it today. But let's pretend this is the stopwatch. The stopwatch cost me $60. The stopwatch that cost me $60 has more computing power in it than the world had in 1950, the entire world. It has more computing power in it than the Apollo 13 mission, the thing that was up on the moon. Did anyone ever see that movie, Apollo 13? Did you see the guys? They got slide rules. That's the explosion of technology that we've had. And faith in the future is the only worldview that squares with the facts. So you have to have faith in the future. The second is patience. Patience. The S&P 500 closed yesterday at 1,100. Can anyone guess what the S&P 500 closed on January of 1943 when my sister Peggy was born? Anyone want to guess? This is the audience participation mode of the presentation. Anybody want to guess? 150, 120? It was 12. 12. You didn't hear wrong. And patience is the virtue that makes certain that you don't do the wrong thing, pardon me. The third one is discipline. Discipline. The average large cap value stock fund, the average one, not the one that was a high performer, the average one from 1987 to 2007 was up 10.46. According to the Dalbar investment study, what did the average investor in those funds get during that same period of time? Take a guess. I'll tell you what it was. It was 4.4%. The average fund did 10.4. The average investor got 4. Why did that happen? What did they do? What they did is they buy high and they sold low. Do you remember I showed you that chart with all of the bear markets? What happens is, what people don't realize is that value is in the inverse of price. When it's at its peak, people are putting wheelbarrows of money into it. And when it's because they think it will go up forever. And what happens is when it goes down, they're taking all the money out. What they have to do is reverse that process. You should always be feeding weakness and selling strength. That's just the way it operates. But everyone knows it. But it's not what they do. That's why behavior is the primary determinant as to whether or not an investor succeeds. And that's what all of your agents should be doing, is dealing specifically with the behavior to make certain that people understand that that's the behavior. Because here's the point. I can't say that the investments that I recommend to you, Mr. Client or Miss Client, are going to outperform most of your neighbors. I don't rule it out. But I can't guarantee it. And you know what? No, neither can any other financial services person out there do that. And what happens is you got to understand that that's very little to do with what I actually do for clients. I say that if you follow my certain principles, you in your lifetime will probably do a lot better than most of your neighbors. Knowing those are two different things and why there are two different things is the beginning of wisdom, and you begin to understand what I do. Let's get to the behaviors. Asset allocation. The famous Princeton study came out and said that asset allocation was responsible for 93% of the return. So if it's responsible for 93% of the return, how come timing and selection gets all the press? It gets the press because if the actual facts can make optimists of us all, The press can make pessimists of us all. They always harp in on very short-term time frames that get people thinking that way. Asset allocation is crucial. The decision to asset allocate between stocks and bonds and what percent I do that is far more important over a 30-year period than the actual selection of those stocks and bonds. That's how important asset allocation is. The second is the idea of diversification. Diversification is a deal you make with heaven. I'm going to give up the possibility of making a killing so I won't get killed. And what diversification is also is it's a study in uncertainty because you don't know. If you knew, you wouldn't asset allocate because you knew. So since you don't know, you asset allocate to be sure that you're buying a series of opposites, that I'm getting something that might be going up while something else is going down. And that's the whole idea behind diversification. And that brings me finally to rebalancing. You have to be able to rebalance your portfolio to make certain that you do the idea that you buy low and you sell high, that you sell strength and buy weakness, and do that consistently. And those are the things that can help a financial behavioralist succeed. Now, let's talk about some lessons learned through this crisis. This is a construction site in the 30s on a skyscraper in Manhattan. Now, believe it or not, in my other life, I used to do this. I was an iron worker. I used to walk the red steel on these skyscrapers. I was on top of the World Trade Center, 110 floors, red steel, for about 4 days. Now, some of you might ask, Joe, do you have a fear of heights? No. I have a terrible fear of heights. I was absolutely terrified. There are beams that probably have my fingerprints in them, but that's what I was doing. Why am I bringing this up? I was on a building in 1971. It was called the Verizon Building. It then became the AT&T Building. It is now the MetLife Building. It's the building I work in. And we were up here with one of these guide derricks lifting steel. And notice all these cables? These cables keep the crane in place. You know what happens over time when you're lifting heavy steel? You begin lifting it and you begin to lose respect. And there was a rumor, I don't know if it's true, that we were beginning to lift heavier loads than perhaps we should have. We were getting beyond the safety margin, but they wanted to finish the job. And so what happens is when you keep lifting the steel, you begin to lose respect for it. You know, you walk under it, things that you really shouldn't do, you know, when you're up on the beams, because you get used to it, because you think it's okay. Maybe we're in a little excess, but it's working. Well, one day I'm up there, and I heard this pang, and one of these cables snapped. Maybe the load was too heavy, and this 1-inch cable swings across the deck, and you got to avoid it because it'll kill you. It will cut you right in half. It won't just bump you, it'll just slice you to pieces. So we're up there and we're watching it, and all of a sudden we see the crane, it's beginning to shake, and you're wondering if they can get it down. The engineer running this crane, by the way, is in the basement. And there's a guy there, a signal man. He's got like an accordion on his chest and bells and lights, and he's frantically trying to tell the guy. And the guy can't see it, but he can feel the strain. So they're trying to lower the steel. And everybody was standing on the deck wondering, will the steel land in the street? It's 42nd Street and 6th Avenue at 8:15 in the morning. And if that steel hits, how many people will get killed? Will they be able to get the steel down? And then what happened is the next cable went, and the next cable went, and the next cable went, and the whole load and the crane, everything went in the street. It was a miracle only one person was killed. So why do I bring that up? While we were up there, no one knew once that crisis started whether or not how it was going to work, how much steel was going to land, how many people would get killed. We just knew we had a crisis. I was in that building, and somebody came into the office when we had a meeting and said, AIG is about to declare bankruptcy in 30 minutes. This is after all the other stuff popped up, and I began to think about it, the heavy load. And you know what the most recent heavy load was? These subprime mortgages. Someone very smart, very left-brained said, hey, we don't even have to know who we're lending the money to or whether they have the ability to pay it back. What we'll do is we'll lend a lot of this money, put it into tranches, and because of the fact that it can go up if interest rates go up, it can get a wider spread, and then what we'll do is we'll pack it with a quasi-governmental organization What is a quasi-governmental organization, by the way? You know, no one figured that out for me. It's Ginnie Mae, you know, and Fannie Mae, and we'll package it together, and we'll sell it to very smart people who want a higher spread and tell them that it's AAA, and everyone will believe it. The load was too heavy. And when the load was too heavy, what first happened is the Countrywide. This was the analogy that popped into my head. It was like the crane lifting the weight that they couldn't do. And the first one that popped was Countrywide. Then it was Lehman Brothers. Then it was Bear Stearns. Then it was Merrill Lynch. Think of the names that we're talking about, Ginnie Mae and Fannie Mae. And all the cables popped and it went back into the street. And then AIG came in to insure the uninsurable. And they made certain that they could insure these investments that didn't work. And sometimes the stuff that we do is self-imposed. And we have to begin to avoid that. How strong are our cables? Make certain we don't lift too heavy a load. I just heard the gentleman who was just talk about the idea that a lot of companies are stretching beyond what they can in order to acquire clients. Our cause is so noble that we really don't need to do that. And that's one of the things. Think of it, AIG, this huge, respectable company destroyed by 100 people in Connecticut who decide to insure the uninsurable. So always make certain that your cables are tight, that the things are there, and make certain that it happens. And so that was, oh, somehow I went backwards. Okay. So what about the impact on others? Sometimes I get invited to speak because I do a lot of research, and so what I'm saying here is a little parody on the research we did. We call it top secret research. It's Joe's interesting and amazing stuff, okay, curious and shocking facts that you don't know. After spending a lot of MetLife's money, what we did is we made an investment and we found out that everyone dies. No, it's true. We're so overwhelming that we went back and did it again. The other thing that we noticed is that people are living longer. Have you noticed there's a lot of old folks floating around? That's because people are living longer. How much longer? In the United States, a 65-year-old male has a 50% chance of living beyond age 85. A woman, age 88, male and female together, who are both 65 at retirement, there's a 50% chance that one of them will be alive at age 92. How are we going to deal with this longevity risk that we've never had before? Well, I love this cartoon. It's from Business Week. It says if we take a late retirement and an early death, we'll just squeak by. But here's one of the real tragedies of it, okay? This is how to protect yourself from your parents. This is a real article from the Wall Street Journal in 2003. This is the impact that you begin to see what starts to happen with society. And I took offense at it because my mother was in a hospital bed in an apartment in Manhattan with 2 kids. And of course I would take care of my mother. But you know what? Some of my siblings didn't live nearby. And so it causes all of those tensions within a family. And that's a big impact. But you know, any discussion about this, the sandwich generation, it's called in the States, the baby boomers who are now taking care of not only children, but their parents, most of the discussion centers around the impact on the baby boomer. Has anyone given any consideration to the impact for the person that the care is being provided? I have a video that I think shows that. Would you play it, please?